Hello, this is Bob Steele. In this video, we will be talking about Chapter 2, Basic Cost Management Concepts. Learn objective number 1, explain what is meant by the word cost. So, process of management. Managers need cost information to perform each of these functions. So remember the main management functions that we talked about in Chapter 1. We had the decision-making process where Disney was the example making the decision to start a new theme park in Florida. And of course, to make that decision, we would need to know some cost information in relation to that. Then we had the planning. So if we were going to plan for the park to be implemented, we would need to know the cost information in order to do that effectively. Directing would be the day-to-day kind of controlling the managers, and of course we need cost data to do that effectively. And then the control being us going back in and seeing how we're doing, comparing. We need cost data to do that, to make projections and whatnot for the future, and strategic planning and marketing type plans. Where do we fit within our market and our business segment, and we need to know cost data for that. So what do we mean by the word cost? It's a little bit more complex than we might first think. A cost is the measure of resources given up to achieve a particular purpose. So I want to contrast that from the word expense. So they're not the same thing. An expense is an asset that has been consumed or a liability that is incurred in order to help us to generate revenue really generally in the same time period. So an expense is basically what we've consumed in order to help us achieve our overarching business goal. Our overarching business goal is generally to generate revenue. A cost, on the other hand, our goal could be to acquire an asset which will help us to generate revenue in the future. So notice that an asset will still have a cost. So we're going to apply the cost to the asset in that case, the objective being to purchase the asset in order to help us generate revenue in the future. So learn objective number 2, distinguish among product cost, period cost, and expenses. So product costs are costs associated with goods for sale until the time period during which the products are sold, at which time the costs become expenses. So if we're in a production process, everything we do within the production will be part of the product cost, meaning it's part of inventory, it's part of an asset until we sell that asset. So if we produce guitars, the purchasing of the materials of product cost, the manufacturing, the direct labor that goes into making the guitars, product cost, the overhead that goes directly into the guitar's product cost. Those are things that are going to be in the guitar. Then we're going to sell the guitar, and that will then be an expense when we sell it in the form of cost of goods sold or cost of goods manufactured. On the other hand, period costs are costs that are expensed during the time period in which they are incurred. So even if we're a manufacturing company that has inventory, we're going to have period costs such as general administrative expenses. The accounting department, for example, would be a period cost because the costs are not directly involved in the production of the product, in this case being like a guitar. They are in support of that. Therefore, we write them off as they are incurred rather than when we sell the product. So expenses are the consumption of assets for the purpose of generating revenue. So remember, an expense is something that we basically consumed, we used in order to generate revenue. So the expense of the product cost when we sell happens not when we, for example, not when we pay the direct labor worker, not when we buy the materials of the guitar. It happens when we sell the guitar. So the cost of goods sold is the expense related to the product costs. Learn objective number 3, describe the role of costs in published financial statements. So we have product costs are going to be costs, once again, that will go into cost of goods sold on the income statement. Period costs on the income statement are operating expenses. So on the income statement of a manufacturing company, we will have cost of goods sold and operating expenses. We have a merchandising company which would buy merchandise and sell it, such as like Amazon, versus a manufacturing company that would make the items. So there's going to be a difference. They both have inventory. So if we looked at their current assets, we'd have cash, we'd have receivables, we've got prepaid expenses. Those are the same. Then we'd have inventory. For a merchandiser like Amazon, they would just have merchandise and inventory because they just purchased it. If we're talking about a car manufacturer like Ford, then we got to break down the inventory to its parts being raw materials, work in process, finished goods. So break those down further. Raw materials means that those materials waiting to be processed. So if we just bought a bunch of steel, it's in the corner, we're going to make a car out of it, that's raw materials. Then once we take the steel out of the corner and we start to make a car in the factory, now it's in process. Obviously it's not completed yet, and therefore it's going to go into work in process, WIP. And then once that work has been completed, we will then take those inventories and put them into finished goods. So all these are going to be a part of inventory, but the finished goods are the only inventory that we can, of course, sell because they're the only ones that are finished. Then we have Learning Objective 4, list 5 types of manufacturing operations and describe mass customization. So when we go into the manufacturing, there's going to be slight differences in the way the way we allocate costs depending on the types of manufacturers we have. So we could have a job shop, which is like low volume, little standardization, and unique products. So when we think about Disney, we're really thinking about like movies. The movies that they produce, we're not going to produce a lot at one time. We're not mass producing the movies where they take time to produce, and they are very unique in the way they are produced. So we're going to treat those differently. We'll have to allocate the cost differently because of that. As compared to a batch type, that would be multiple products at a low cost, such as Caterpillar. So Caterpillar has construction equipment, and they're going to have multiple products with a low volume. We have assembly line where we would have a few major products at higher volume, such as Ford. So Ford has a limited amount of products, and they do a high volume. So that would mean we're going to account for that. We're going to have to allocate that cost in that format. What would be the best way to do that, we'll talk about. And then continuous flow, high volume, highly standardized commodities. So if we're talking about Exxon, if we're talking about refining gasoline or making taffy or something like that, where it's a very standardized process, then once again, we're going to treat that somewhat differently in terms of how to allocate the cost. So depending on the type of product process, we will then allocate the cost slightly differently. We will have the same pools, meaning we'll have raw goods, we'll have work in process, we'll have finished goods, then it'll go to cost of goods sold, but the way we allocate between those pools will differ somewhat by the type of production process. And that is it for this presentation.